Hey everybody, Kamari Ellis here for another edition of Ask Kamari's Investing Basics Challenge. Today is day number 22. 22 folks. It's been a long journey, but we're almost there. Today, just wanted to talk a little bit about risk, investment risk to be particular, and the top 4 risks, or my top 4 risks that I think all investors need to think about when investing in anything. All these risks usually affect investments in one way, shape, size, or fashion. The top 4 we're going to talk about today are inflation risk, default risk, market risk, and geopolitical risk. So number 1, inflation risk. Basically, inflation risk. Inflation is the rise of cost and goods over time. Remember I gave that example before about a tank of gas. And 1993 was about 98 cents, and today it's north of $3.60. I think I paid $3.65 last time I got gas. So gas is up drastically over these last almost 20 plus years, 21 years almost. So that's inflation. And inflation risk is simply the fear that your investing or your cash or your ability to purchase things will not keep pace with inflation. So let's say in 1993 I had $10,000 and it could buy, let's say, 10,000 gallons of gas, roughly. But here we're in 2014, and that same $10,000, I'm going to go to the calculator for this real quick, can only buy 2,739 gallons of gas. That's a big difference. So that's inflation risk. So when we are factoring in for our investments, we want to think about inflation risk. We want to make sure that we're able to outpace inflation. We want our investments to outpace inflation 9 times out of 10. Number 2, default risk. So anytime you're investing in something, there's a chance that a company, usually especially with stocks and bonds, but a company could go out of business. A country could also go out of business as well, again, done with bonds. But that kind of straddles geopolitical a little bit, but I'll come to that a little bit more. But they could go out of business. So think about Enron, that might be dating some of you folks. Not too long ago, Bear Stearns, Lehman Brothers, they all went out of business. GM had to file for bankruptcy. That's a default. They couldn't make good on their payments. It's like, let's say you loan somebody some money and they just suddenly disappeared and you couldn't get that money back. That's a default. All right, so that's the other thing you got to factor in with your risk. How big of a chance or probability will you have with a company or a country skipping out on you or going out of business and not paying you back or not being in business? All right, so that's number 2. Number 3, market risk. Now, we've seen time and time again over the years that the market always does something funky. We can go way back in the day, in 1929, where stockbrokers were jumping out of windows because the market crashed to 87, Black Monday, to 2008, October 2008, when the market crashed. That's another thing, market risk. Now, again, it's not anyone's fault. It's not. So market risk, number 3 on the list. So the market does funky things every so often, every couple of years or every couple of decades. You can go as far back as 1929, the stock market crash. You could think about Black Monday in 87. You could also go back to October of 2008 when the market fell. It just fell because of some major thing going on in the market, and then it had to correct itself. And usually it comes back. Not always, but depending on the timing of when you may need your money. Remember, we talk about time horizon. All of that always has to be factored in. So you always have to be thinking about market risk and how much market risk you really want to take. We'll definitely get more into that once we put together the investing, 201 series or intermediate series as well. Number 4 is geopolitical risk. Every time Israel has a problem with someone in the Middle East, or someone in the Middle East has a problem, you usually see the cost of oil fluctuating, or you may see stocks start to fluctuate because they're scared. Now we have everything going on over with Russia and the conflict in Ukraine. That's another example of geopolitical risk. Things will start to get a little crazy. People will tend to run for the hills. Remember, we talked about back in, I believe it was back in video number 5, about risk tolerance and the market gyrations and how you can deal with those, but also and the market anatomy and video number 8, how you can make money in any different market. So don't be afraid of geopolitical risk, because you can make money in any particular market, but you want to be aware of them. You want to know if, let's say, you are investing heavily in Russia and you feel that the United States is having problems with Russia. Right now might not be a good time to be long anything in Russia. It might be a good time to be short some things in Russia, but you just have to approach it from that mindset, and say, hey, or I can look in somewhere else in the world where the United States, if you're here domestically, has good relationships with, and you're not worried about the outcome for either bonds or stocks or commodities or other things. Even with Russia right now, Russia produces a large amount of wheat, as well as natural gas and oil. So you'll see all kinds of different fluctuations going on in the marketplace regarding those things. So you always want to keep an eye out for them. So that's it. That's my top 4 investment risk that you want to keep an eye out for: inflation risk, default risk, market risk, and geopolitical risk. Those are the 4. So I'll see you back here again for video number 23. We're going to start talking about the different investment vehicles. We're going to start talking about accounts. There are all different kinds of accounts, and a lot of times people get confused by that. So I just want to take a quick minute and talk about the various different kinds of accounts. So I'll see you right back here for video number 23. Don't forget to subscribe to the Facebook channel and share these with your friends and family. I'll talk to you soon. Bye-bye.